Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're going to talk about how to utilize options to allow us to profit from any market condition, whether we have a bullish outlook, a bearish outlook, or even a neutral outlook. This webinar is more so for those of you that are relatively new to options. We're going to talk about basic principles of basic strategies that you can utilize for your portfolio to take advantage of different market conditions and show you the flexibility of options. This webinar is also designed for those of you that do have a little bit more experience and want to learn more in depth about each one of these strategies, but I will try to spend most of my time trying to keep things at a relatively beginner level and spend as much time as possible using the Options Play software that you guys all have access to free of charge to try to present these strategies so that you have an understanding as to how to utilize them in practice with your real portfolio. And at the end, I'll try to go through as many symbols as possible to show you some examples of live setups and how you can utilize options to take advantage of any different market outlook. So let's go ahead and get started. A quick disclaimer, everything that we're going to discuss here today is purely for demonstration purposes and is not a solicitation or recommendation to buy or sell any specific securities. And for those of you that are brand new to Options Play, for those of you that are brand new to Options Play, remember that you guys have access to the tool that I'll be showing you here today, free of charge, courtesy of the Montreal Exchange. And you can access it using this link right down here, which I will post into the chat window for those of you that want to sign up. And this gives you access to the free software, Options Play, gives you also access to the bi-weekly options education webinars, a free on-demand video library, and weekly cover call and short put reports that are really useful in helping you leverage some of the strategies that we're going to discuss here today. So make sure that you sign up for this if you don't already have access. So let's go ahead and get started. First off, what I really want to make sure that everyone understands before we jump into any option strategies is really understanding what is the fundamental difference between trading stocks and trading options. Once we understand this fundamental difference, that's when we're going to dive into three basic strategies. We're going to look at buying call options, which is suitable if you have a bullish outlook, buying put options if you have a bearish outlook, and then selling cover calls when you have more of a neutral outlook on an underlying stock or ETF. So once we understand these strategies from a fundamental perspective, I want to do a little deeper dive and really discuss the option Greeks, because it's one thing to understand the strategy. It's a whole nother thing to understand how these strategies relate to profit and risk. A lot of users that are getting into options, do not really understand the risk and fundamentally find it risky because they don't understand the risk. So we really want to make sure that we cover basic understanding as to how these option prices move so that you can get a sense for what you should expect if you were to trade one of these option contracts. And then lastly, we'll discuss some of the common mistakes that users typically make with options trading, especially when they're first getting started, so that hopefully help you prevent you from making those same mistakes. And then lastly, what we'll do is we'll jump into options play to show you some of these strategies. So before I jump right into it, I just want to get a quick glance of the audience. So if you can please bring up your chat window, which is at the bottom of your screen, and please type new if you're new to options trading, or experience if you have some experience trading options. I just want to get a sense for the audience here in the room. So again, new if you're new to options trading, and experience if you have some trading experience with options. Okay, great. Looks like I have a lot of news, but also a lot of users who say that you have some experience. So it looks like we've got a pretty diverse group here, which is great. For those of you that are brand new, I hope that this enlightens the power of options and the flexibility and the different things that you can do with it. And if you have some experience trading, I hope that this is a refresher course and also provides you with a different way to look at calls, puts, and cover calls that maybe you haven't really thought of in the past. And it really hopefully helps frame whether or not you should always buy call or put the next time you're bullish or bearish on an underlying stock. So let's go ahead and get started here. Whoops, I don't know why this keeps happening. So let's first discuss the difference between trading stocks or options. So whenever we're talking about trading stocks, this is really where I would consider the strategy pretty simple. But the problem with trading stocks is that it's fairly limited in nature in terms of what you can do, because you really only have one sense for exposure, which is direction. And that means you can either believe that the stock is going to go higher, or you believe the stock is going to move lower. It's one of those two. You can either go long the stock because you think it's going to go higher, or you can go short the stock because you think the stock is going to move lower. Now, with options, you have a lot more complexity, but with that complexity brings flexibility, meaning you're going to have a lot more ability to trade and have different outlooks and be able to express different outlooks in many different ways, because sometimes we don't just always have a straight bullish or bearish view on an underlying stock. Perhaps sometimes you have a bullish but more bearish view. You think the stock is going to rise and then you think it's going to fall, or you think the stock is just going to stay within a certain range. You think maybe it's just going to trade between two support or resistance levels. So you have a lot more flexibility with options that really allow you to express any possible outlook you have on the stock and be able to profit from that, simply utilizing options that you wouldn't be able to do if you're trading stocks. So whenever you're trading options, you have three different types of exposure. You still have exposure to direction. You have exposure to magnitude, meaning whether a stock is going to go 1% higher, 3% higher, 10% higher. You can get different levels of exposure on magnitude. And lastly, you have exposure to timing, something you don't get when you're trading stocks, because a stock, you can hang on to that trade for as long as you want or as short as you want. With options, you have an expiration date, and every outlook that you have has to happen within that expiration date. So with this flexibility or with this complexity, instead of just choosing between long stock or short stock, you can either buy or sell a call or a put. So instead of having two options, you now have effectively four different options. And this can, and in the next slide, I'm going to discuss these four different options and what they actually mean, so that you have a better understanding as to how to structure these. So the second thing you can look at is magnitude. And this is where, with options, not only do you have a choice of either buying or selling a call or a put, you also have to choose a strike price. A strike price helps you express the magnitude view that you have, or the magnitude outlook that you have on an underlying stock or ETF. And lastly, like I said, options have expiration dates. So you have to choose not only buy or sell a call or a put, but also a strike price and an expiration date. So you have a lot of things that you have to choose from. So today what we're going to discuss is what those things mean and how to go about doing that. So let's go ahead and start taking a look at the specific strategies. So when we're talking about, or the strategies we're going to cover here today span two different categories. The first one we're going to talk about is generating income. The second one is speculation. Generating income, I think, is pretty straightforward. You're trying to utilize options to generate an income stream. Think of like collecting dividends on a stock, generating income stream on the stocks that you own, similar type risk profile and similar type income stream that you'd be able to generate by selling covered calls. And speculation is simply having a bullish, bearish, or perhaps even neutral outlook on an underlying stock or ETF and wanting to profit from that outlook if you are correct. So when we're talking about generating income, this is the first and foremost strategy that you'll find when you're trading options, because the first trade that you're allowed to make when you apply for an options agreement is selling cover calls. So this is a very simple strategy that allows you to sell a call option against the stocks that you own in your portfolio. So take any stock that you own in your portfolio, whether you own IBM stock or Apple stock or the Q's ETF, any stock or ETF that you currently own. You need at least 100 shares of that stock in order to sell a cover call. What you want to do is you want to sell a cover call that's roughly 1 month from today, so an expiration date that expires roughly 1 month from today, and you want to sell an out-of-the-money call option against that stock in order to generate income. So an out-of-the-money call option refers to a strike price that's above the current price of the stock. So if you have a stock that's currently trading at $100, you might want to sell a call option at maybe 105. So above the current price is where you want to consider selling that cover call. So that is a basic strategy on how to generate income on utilizing options. I'm going to come back to this to give you some more concrete examples. The second strategy we're going to talk about is speculation. This is where you have a bullish or bearish outlook on an underlying stock, and you want to express that, and you want to be able to profit from that if you are correct. So you can either buy a call option if you're bullish, or you can buy a put option if you're bearish. Now, both of these strategies, the reason that most users are interested in using a call option or a put option instead of going long the stock or short the stock is that both of these strategies have what we call limited risk, meaning that what you pay for the option is the most that you can lose no matter what happens. If you think the stock's going to go higher and you buy a call option and the stock plummets to zero, you don't lose $100 a share. You only lose what you paid for that call option. Vice versa, if you think a stock is going to move lower and you buy a put option and the stock rockets up to $300, you don't have unlimited risk. You're limited to what you pay for that put option. So that's really the asymmetrical risk-reward ratio that people are seeking when they buy an option, is they want to be paid if they're correct with unlimited upside, but they want to have limited losses in the event that they're wrong. So a good starting point with this strategy is to buy an option that's roughly 1 to 2 months from expiration. So again, we talked about you have to choose an expiration date. So whenever you're buying an option, usually you want to go about 1 to 2 months out. And generally you want to buy an in-the-money strike option. So this is where if you're buying a call option on a $100 stock that you think is going to go higher, so if the stock is currently trading at, let's say, $100, you might buy either a 100 strike call or maybe a $99 call option. And vice versa, if you're buying put, you might want to buy maybe a 101 put. So a slightly in-the-money put or call is usually suitable for buying options. Unlike when you're selling options, you want to sell an option that's further out of the money. So those are the different general rules of thumb that you want to follow. Again, if you're brand new to this, this is going to be a learning experience that is not, you're not going to be able to learn how to trade all of these strategies just by watching a 10-minute video. It takes time. So if you're brand new and some of this seems difficult for you to learn, or these are terminologies that you don't understand, don't worry. This is a learning process, and we're here to help you through that process. So for those of you that are brand new, one of the things that is typically confusing is the fact that you can buy or sell a call or a put. Unlike going long a stock where you're bullish or short a stock if you're bearish, there are 4 different combinations, and sometimes it's confusing as to what is actually bullish and what's bearish. So this is a way to demystify what you're trading with just basic multiplication. So what we're going to do is we're going to assign a value to buy or sell and call or put. And I think it's pretty straightforward to understand why buy would be positive, a sell would be negative, a call would be positive, and a put would be negative. So if we assign these values to these 4 contracts, or these 4 inputs, we can easily use multiplication to get a sense for whether a strategy is bullish or bearish, because all we have to do is take the fact that if we multiply a positive with a positive, so when we're buying a call, that's going to be bullish. When we multiply a negative by a negative, so when we sell a put, that's also going to be bearish. But if we sell a call, which is multiplying a negative with a positive, that's bearish. And lastly, if we buy a put, which is multiplying a positive with a negative, that's bearish. So the next time you're thinking about this and you quickly want to remember, am I trading a bullish or bearish strategy? Just think, am I buying a call? If it's positive and positive, that's bullish. If you're selling a put, that's a negative and a negative, that's also bullish. That's a quick way to remember what strategy you're trading. And especially if you start getting more complicated and you're mixing calls and puts, and you're maybe buying a call and selling a call at the same time, you can remember how to construct these in conjunction with each other to remember where you're bullish, where you're bearish. And this is really where it comes into the flexibility of options, because when you're long a stock, you effectively believe the stock is going to go all the way to infinity. But what if you don't think the stock is going to go infinity? What if you really think it's just going to go from 100 to 110 and that's it? How do you express that? So with options, you have a lot of flexibility. I can buy a 100 strike call, which is the bullish piece, and then I can sell a 110 call against that, which is basically saying that I'm bullish, but I don't think it's going to go above 110, and I think it'll basically maybe flatten out at 110 or maybe even move a little lower. And this really truly allows you to express different outlooks in the market with a small amount of capital versus buying that stock and risking $100 a share to make that same bet. You can make the same bet with just maybe $4, $5, $6 instead of $100 a share. And that's really where the flexibility of options comes into play. And I think the best way to illustrate this is using a bit of visual. So like I said, when you're buying a stock, it's very straightforward. You can either buy the stock when you're bullish, or you can short the stock if you're bearish. And for many users, shorting a stock is simply not an option that you have, because many times you might find yourself in a position where shorting a stock, you may not even have the ability to trade this because maybe your broker doesn't allow you to short the stock, or maybe a stock is hard to borrow. So you might find yourself really only having one option of buying the stock. And which basically means that you're only seeking opportunities on a stock where you think it's going to go higher. If you believe it's going to move lower, you probably just move on to the next stock because you really don't have a way to profit from that stock moving lower. And what that many times does is it limits the trading opportunities that you can find, because not only do you have to believe a stock is going to go higher, you have to believe it's going to go high enough to offset the risk of buying a stock at $100 a share. Because if you buy a stock at $100 a share and you only think it's going to go to 102 or 103, you're effectively risking $100 a share to try to make $2 to $3 a share. Many times that's not worth the risk. So unless you thought the stock was going to go to 110, 120, 130, that's the only time where it makes sense to buy that stock. And that opportunity doesn't come every day. And you may not be able to find opportunities like that very often, especially when markets are at all-time highs, when markets are fairly overvalued and overbought. It's hard to find stocks to buy. And that's really where options comes into play. Now, the good part about stocks is that you get what we call immediate gains. So on a $100 stock, if I buy 100 shares and the stock goes up even by a penny, I start making money on that trade immediately, as long as I get the direction correct. However, what I have is what we call symmetrical exposure, which means that if it goes up by a penny, I make a dollar. If it goes down by a penny, I lose $1. So it's dollar for dollar, whether it goes up or down, how much I make or lose. And I can do this for any time horizon, because I can be bullish on a stock for the next 5 minutes, the next 5 days, the next 5 weeks, the next 5 months, or 5 years. I can hold on to a stock for as long as I want. But when I'm trading stocks, I have no neutral options, which means that if it's a $100 stock and I'm not too bullish and I'm not too bearish, I think it's just going to stay within a range. There's really nothing I can do as a stock trader to take advantage of that. So that is what it's like to trade stocks. And if any of you are stock traders and you understand this, please type 1 into the chat window, just so I understand, just so I can make sure that everyone understands what I'm saying here. Trading stocks, there's limited functionality, there's limited abilities in what you can express in the markets with the stock investment, but it is simple to understand symmetrical exposure, and you can't trade neutral options. Great. So I see a lot of ones. Great. So everyone understands what I'm saying. So if you understand this, now let's compare this to buying a call option. So now let's just look at the bullish trade. So I think a stock's going to go higher. Let me take a look at an option. So when I buy a call option, when I'm bullish on the stock, now unlike the stock trade, where as long as the stock goes up by a penny, I start making money. When you buy a call option, it only profits if the direction and the magnitude moves higher than the premium that I pay for the call option. What that means is that buying a call option is not free, and this will be a little bit more apparent on the next slide. But whatever I pay for that option, the stock not only has to move higher, it has to move higher by the amount that I've paid for the call option and more before the strategy is profitable. If it moves less than the amount that I paid for the call option, I actually still lose money, even though the stock went in the direction that I expected to. So sometimes you can buy a $5 call option and the stock only moves $2 or $3 or $4 in your favor, and you still lose money. And that's something that many people have a tough time wrapping their head around, is that when you buy a call option, the stock needs to move by that amount in order just for you to break even. So in order for you to be profitable, the stock needs to move more than the $5 that you paid before you get profitable on the specific trade. And you have only until the expiration date. So if the stock goes like this and then goes like that, after, let's say, 2 months, you're too late because it's already past the expiration date. So not only does the stock need to move in this direction, it has to move in this direction before that expiration date. So you have to keep in mind this expiration date that you've chosen on your call option, and it has to make that move before that expiration date. So those are all the things that need to align in order for a call option to work out. So at this point, you might be saying, well, why would I want to do that? It seems like a lot to accomplish in a short period of time. And the answer is because of one very, very specific reason. When I buy the stock and I think it's going to go higher, I'm risking $100 a share. But when I buy a 1 month call option, let's say I buy a 100 strike call at $4, yes, this strategy needs to move, this stock needs to move by $4. So effectively a 4% move to the upside just to break even. So I need to get a 5, 6, 7, 8% move to the upside before I'm really profitable on this specific trade. But if I'm wrong, meaning if instead the stock plummets, right? And this is really where we need to think about the risk of every single trade. What happens if this stock goes back down to $90? What if instead of going 10% higher, it goes 10% lower? If I bought the stock, I'm risking 10% of $100 per share. But however, when you buy an option, you're only risking the $4 a share. So no matter what happens, even if the stock goes all the way to zero, I'm still only risking $4, not the $100 that I would have to pay if I went long in the stock. So that's the payoff that you have when you're trading an option is, yes, the stock needs to move a little bit more in order for you to be profitable. But if the stock moves substantially lower, you don't experience the same pain that you do if you trade the stock. And you still participate in unlimited gains. So let's just say this stock has earnings or some kind of event comes and this stock really takes off. You participate in all of that. So a call option gives you unlimited upside and protects you to the downside. And that's why I have this red that simply stops at a certain level. So no matter what happens, even if the stock goes to zero, I'm still protected as if the stock cannot go below $96, $6. And that is the benefit of trading a call option. So again, if that makes sense, please type 2 into the chat window. So I hope that help explains the difference between trading a stock versus trading an option, because they might seem similar, but they're actually quite different in nature. Great, so I see a lot of 2s. So now let's take a look at the bearish side. And really the bearish side is exactly the same as the bullish side, just flipped on a dime. So when you buy a put option, you only profit if both the direction and the magnitude of the stock moves lower by more than the premium that you paid on the put option. And this strategy gives you limited risk. So no matter what happens, even if the stock, so I'm bearish on the stock, I think it's going to move lower, But instead, what happens if the stock just takes off, right? What happens if some news comes out, some unexpected event comes out, Fed cuts interest rates, and this stock just rallies? When you short a stock, you truly have unlimited risk. When you buy a put option, you have this limited cap. So no matter what happens, you can't lose any more money than the premium that you pay. But again, you only have exposure until that expiration date. So that expiration date right here, you only maintain exposure up to that expiration date. Anything that happens after that doesn't matter because you're not participating in that. So in the same example, if I have a $100 stock that I think it's going to move lower, let's say I buy a 1 month put option for $4. So this strategy is going to be profitable as long as the stock is below $96 at expiration, which is the $100 minus the $4 that I pay. So in this event, instead of just requiring the stock to move by 1, 2, or 3, or 4%, if it moves 4%, I break even. If it moves less than 4%, I actually lose money on this trade. So this stock needs to move 5, 6, 7, 8, 9, 10% in order for this strategy to be profitable, and it has to make that move before the expiration date. However, if the stock does rally, no matter how much higher it goes, I'm limited in my losses so that no matter what happens, that's the most money I can lose. And the most money I can gain is unlimited. So if this stock goes all the way down to zero, I keep making more and more money all the way down to zero. So that's a trade-off that you make with options, is that the stock needs to move a significant amount before the strategy is profitable, but I have cap losses and I participate in downside as much as possible, as long as it keeps moving lower and lower. So again, if that makes sense, please type 3 into the chat window. Puts should be relatively simple to understand once you understand calls, because again, it is the exact same trade, just flipped on a dime for bearish opportunities. And this truly allows you to trade a bearish opportunity. Even if you don't have the ability to borrow stock from your broker, you don't want to pay interest margin to your broker to borrow a stock and hold on to it indefinitely, a put option allows you to express a bearish view in the markets without having to do any of that. The money that you pay is the most that you have to risk, and there's no margin required to buy a put option. So those are the different ways that you can express a bullish or bearish view in the markets using options. So lastly, let's take a look at cover calls. So again, cover calls allows you to collect income on the stocks that you own. So if you own Facebook stock, or if you own Netflix stock or Tesla stock, these are all great stocks that perhaps you might own in your portfolio. But these are also stocks that currently do not pay a dividend, which means that holding onto the stock, the only way you'll make any money is if the stock moves higher. What happens if you're holding onto a stock and you think it's just going to move maybe sideways for a little bit of time? Maybe you think it's going to go higher in the future, but for now you think it's just going to stay sideways. What can you do? Cover calls allow you to generate income as long as the stock stays within a certain trading range. So what you're effectively doing on a $100 stock is you're selling a strike price above the current price. So think of it as placing a limit order somewhere up here and saying that if the stock rallies, I'm okay with losing my stock, because when you sell a cover call, it's kind of like a limit order. You're basically obligating yourself to sell your stock at that higher price between now and the expiration date. So at expiration, if the stock is below that price, you keep the stock and you keep the income. If the stock is above that strike price, then you've effectively sold your stock at that price in the future, just like a limit order. And what you generally want to do is you want to pick a level that is high enough that, generally speaking, has a relatively low probability of hitting, so that as long as the stock stays within this specific range, you get to keep the income by the expiration date and do it all over again. So if the stock trades within this range, you keep that income and you do it again next month. The next month you might choose maybe a strike price up here because the stock has moved up a few points. And the month after that, maybe it moves down a few points, and you just keep selecting cover calls, and you want to try to generate yield on the stock until the stock rallies, and that you lose the stock and you take profit on the stock if the stock closes above the expiration date on the closes above the strike price on the expiration date. So that is another strategy. Now, I actually have a whole webinar just on selling cover calls. I don't think that this one slide does this strategy enough justice. So if you do want to learn more about cover calls, I highly recommend that you take a look at our previously recorded webinars, which I will post a link during our Q&A session in a few minutes so that you guys can access that Q&A video library or that options video library, which includes the strategies on how to sell cover calls and more in-depth information about both of these strategies that I expressed here today. So if that makes sense, if the cover call strategy makes sense to you, please type 4 into the chat window, just so I can get a sense for whether or not people understand what a cover call is. Okay, great. A lot of 4s, which is great. So what I want to do is, and I'll skip over this because I think I just covered this from a high level as to what this means. But what I want to do is I want to jump over to looking at the option Greeks, because this is an important topic and I want to cover this before I jump over to options play. The option Greeks is because, we talked about a stock being symmetrical exposure, which means that if the stock moves up by $1, you make $1. If it goes down by $1, you lose $1. So an option trade, if the stock moves up by $1, the option is not going to move by that same $1. So an option has a term that we call delta. And what delta tells us is the change in the price of the option with respect to the change in the stock price. So when we have a symmetrical exposure of dollar for dollar exposure, that means that you have a delta of 1, meaning for every $1 goes up, it moves up by $1, every $1 moves down, you lose $1. So when an option has a delta of 0.5, that means for every $1 the stock moves up or down, the option will move half as much, so 50 cents. Now, that sounds like you're not getting as much bang for your buck. However, if you think about it, on a $100 stock, when the stock moves up by $1, you make $1. But on an option, it might only cost you $5 to make that. It might only cost you $5 to buy a call option. So if the stock moves up by $1 and your call option moves up by 50 cents, that's actually a 10% increase in your option price when the stock only moved 1% higher. So this is really the leverage that you actually get from options, is that even though it moves by a smaller dollar amount, because you start off with such a small dollar amount, it's actually a larger percentage move in your underlying stock. So delta gives you a sense for how much should you expect to make or lose on your option if the stock moves $1 in your favor or $1 against you, giving you a rough estimate as to what your P&L is on every single trade. Now, what I'm explaining to you is simply just for conceptual purposes. I don't expect you to remember this. I don't expect you to do the math in your head. Options play actually calculates all of these things for you, but it's just important to understand these from a concept. The second thing that's really important to understand is theta, because like I said, options have an expiration date. So the value of an option actually decays as you get closer and closer to expiration. And the pace at which the option decays is what we call theta. So the change in the price of the option with respect to the change in time. So as time goes on and on, what you're going to see is that the value of your option is going to decrease. And as you get closer to closer expiration, that decrease actually accelerates, because the less time you have left to go, the less opportunity for that call option to be worth anything. So what theta tells you is how much the option price will lose per day. So if you see a theta of 0.05, that's telling you that the option is losing 5 cents in value per day. So you might have a $1 move in your stock that results in a 50-cent increase in the option price. But if the stock makes that $1 move over 10 days, the delta will basically be offset by the theta, and the two will effectively cancel each other out. So that's why delta and theta are the two most important Greeks to understand whenever you're trading options. So those are the two primary Greeks that I want to cover. And with that, what I want to do is I want to jump over to options play, and I want to show you guys some real examples, because that's how I think most people learn. So I have the TMX options play platform up. Again, if you don't have access, we will show you how to access this platform completely free of charge, courtesy of the Montreal Exchange. And this platform is really designed from the ground up to try to make your options trading experience as easy and as simple as possible. And we did this because we understand that when you guys are trading options, you guys are looking at pages that look like an options chain, okay? And any of you that have ever traded options, you're probably familiar with an option chain that looks something like this. If any of you have used an option chain that looks like this, please type 5 into your chat window. You know, these are pages and pages of expiration dates and strike prices. And honestly, looking at a page like this, it's kind of like looking at a phone book. It's looking at like a directory saying all the different things that you can possibly do in the universe of options is here. Just go and figure out what you want to do. And many times that's not easy to do because there's no guide for this. It just lists a bunch of numbers. And most people don't really know where to start. And that's why we created options plays, because we thought the option chains were too difficult to navigate, even for professional traders. It's not always easy to understand where to start. And as professional traders, we've had to figure out roughly how to use these pages and quickly get to a sense for where to start. But once we figured that out, the different calculations that we needed to do to say, if I was to buy this 100 strike call that expired on October 11th and the stock went 5% higher, how much money do I make? How much money do I lose? That's the stuff that we used to have to do back of the envelope calculations. And whenever you do that, sometimes it's prone to error. So we wanted to create a platform that was a lot easier, did the work to help you decide where to start and help you analyze it with real calculators so that you don't have to do any back of the envelope calculations. So let's take a look at that, right? So I was looking at the S&P TSX 60 index today, and despite the market making a relative high recently, what I've noticed is that the market has really started to pull back after making that high. And it looks like it's pulling back below some major support levels. So, you know, we saw some major support around here, but looks like the market is starting to crack below those levels, you know. So today was the first day that we closed below that level. So I do think that maybe we'd have some further downside to the movement. So I wanted to take a look at some bearish opportunities in the current market that I see. And again, this is for illustrative purposes. This is not a solicitation or recommendation to buy or sell any specific securities. Now, I was looking at some of the banks, and the banks really started to look quite weak today. You know, TD that recently tried to make this big push higher, as you can see. This stock really, I think, made a pretty earnest move to the upside. As you can see, it went from early September through October, made a pretty big move to the downside, and recently just closed below that $76 support level. So I think that maybe this might revisit back to that 72, 73 level, even though things are pretty strong, even though this is bearish, bullish currently. I'm just using this as an example. Again, not a recommendation to go short TD, but as you can see on our platform, you have your choices. We're not telling you what to trade. You can select either I'm bullish and see 3 bullish strategies, or select I'm bearish and see 3 bearish strategies. So I can either buy the stock or buy a call option if I'm bullish, or if I'm bearish, I can short the stock or buy a put. So what I wanted to take a look at is, okay, let's say the stock's trading around 75, 25 right now, and I think the stock is going to revisit the 73, maybe even 72 level that it was trading near in early September. So what I can use is, number one, this platform provides starting points, meaning I don't have to pick a starting point based on expiration dates and strike prices. It already picks for me the November 15th $76 put. And this is based on the best practices that I just taught you on this page. So as we were saying before, when you're buying an option, you want to buy roughly 1 to 2 months out, and you want to buy an in-the-money strike. So our platform already applies this on the spot for you for any symbol that you type in and the bearish strategy. So it looks for a November 15th, which is somewhere between 1 to 2 months from today. And it picks a $76 put, which is the first in the money put on TD. And what it does is it helps me compare that strategy with shorting the stock, presuming that I can short the stock. And as you can see here, if the stock declines down to about $72 by the November 15th date, so let's say November 15th is roughly right here. Whoops, let me see if I can try to draw this for you. November 15th is roughly right there. So if the stock, makes a move to the downside, maybe it takes a little bit of time for that to happen. Maybe it doesn't move straight down there, but maybe it takes a little bit of time, moves down to 75, moves up a little, and then moves down to 72. I think that type of level, 72, is well reasonable within that November 15th timeline. So if I think the stock is going to go down to $72 by November 15th, as you can see, if I shorted the stock, I make a 4% return. If I buy a put option, I make a 73% return. And that's really the type of leverage that I'm looking for when I'm buying a put option. And I'll be perfectly honest, a 73% return, it's good, but it's not that great actually. And conversely, what if I'm wrong? What if the market just takes off again? What if this stock rallies back up to 79, which is its 52-week high? Actually, its 52-week high is higher, even $80. So what happens if this stock takes off and goes back up to $80? If I had shorted the stock, I'm losing $485. If I buy a put option, I only lose $231. So not only do I make a better return if I'm right, if I'm wrong, I'm risking less than half the amount that I would risk if I had shorted the stock. And that is the benefit that you get when you're buying a put option. Now, for those of you that are a bit more advanced, you're going to be gravitating towards this strategy that has a higher options play score. And you had saw if this stock went down to $72, instead of making roughly a 73% return, I'm looking at a 146% return. And if I'm wrong, I'm only risking $162 versus $231. Now that's for another day for those of you that are a bit more experienced to look at a more advanced strategy. But this is really this tool that allows you to type in any stock, instantly type in either I'm bullish or I'm bearish. Look at Royal Bank of Canada. We recently put in this double top here. Now, there's many different ways that you can view this from a technical analysis perspective. You can either believe that this is a double top that's about to reverse lower with the market as it potentially moves back lower, or you can see this as a potential breakout to the upside. And what you might be looking for is a breakout and that the stock, maybe you think the stock is going to break out a little bit to the upside. I don't know why my drawing tool is not working. Maybe you think it's going to break out a little bit to the upside, come back, test it, and move higher. There's many different ways that you can look at this. Either way, this tool allows you to select either I'm bullish, take a look at 3 bullish strategies. So let's say we're in the camp that we believe Royal Bank of Canada is really strong. It's held up really well while the markets have sold off. So you think that as long as this market gathers any bit of strength, there's a good chance that the stock will break out to the upside. So let's take a look. Buying 100 shares of this stock would cost me $10,000. Some of you may not even have $10,000 to spend on 100 shares of this stock, but I can control 100 shares of the stock by buying a call option. So again, this picks out for me not only the expiration date, but also a strike price of 105, which is in the money for a $106 stock. So I can either buy 100 shares for $10,000, or I can buy a call option for $262. So roughly 2.5% of the underlying cost, I'm able to control the same amount of upside while risking only 2.5% to the downside. So that if the stock pulls back more than 2.5%, I'm limited in my losses. So if the stock does plummet back to 104, 102, even to its September lows, in early September, this is a $100 stock. If it pulls back to that level, I'm risking substantially more. So if the stock pulls back to, let's say, in this particular case, let's say the stock pulls back to 100. If the stock pulls back to 100, which is, from what I can tell, just what it was trading at in early September. Less than a month ago, it was trading at 100. It was trading as low as 97. So if this stock can revisit 97, if you bought 100 shares of the stock, you're risking $921. Buying a call option, you're only risking $262 because that's how much you're paying for the call option. No matter what happens, that's the most you can lose. Now, the upside is the fact that if the stock goes higher, the stock needs to move by a bit. It doesn't have to move by much. It only has to move up by about 2.5% before the strategy is profitable. So even if the stock moves up to just roughly 107, which is about $1 higher, a little over $1 higher, this strategy will break even. So as long as it moves more than a couple of percent higher, it moves up to 110, 112. As you can see here, you're looking at about 122% return on your $262 invested versus only about a 4% return on your $10,000 invested. And again, for those of you that are a bit more experienced, you might want to take a look at that vertical spread. And as you can see here, this spread allows me to make the same return with a smaller amount of risk. So instead of risking $262, I can risk $225. So there's different strategies that you can trade, but this tool is really designed to allow you to quickly type in any stock that you have a bullish or bearish view on and instantly start taking a look at starting points to compare buying the stock to buying a call option, or shorting the stock to buying a put option, and using the P&L simulator to see how these strategies perform based on your outlook on the underlying stock. And even if you expect the stock to make that move in a shorter amount of time, so maybe there's a catalyst event, maybe there's a product launch or a news event, a news announcement, or maybe even earnings that you think the stock will make a move after. You can use this tool to model where you think the stock will go by what time, and it will show you exactly how the strategies will perform so that you can make an educated decision as to how much money are you risking and how much money can you potentially make on each strategy. And lastly, before I open this up for Q&A, if you click on the income tab, now this is for those of you that own the stock, you want to generate some income. Perhaps you think a stock like Sucor Energy, maybe you think the stock is losing some steam. It's already made a huge move to the upside from early September to here, and maybe you think the stock is going to pull back a little, but you still want to own the stock because maybe sometime down the line you think the stock will continue to move higher, or maybe you think the stock is going to move sideways for quite some time before it moves higher. During that time, what you can do is you can generate yield. Now, Sucor Energy already pays a pretty nice 4.5% dividend. Or 4% dividend, which is a pretty hefty dividend, but you can increase that by selling cover calls. So you can sell a 42.5 cover call. In this particular case, that generates an additional 7.5% yield. So you're already getting a nice 4% dividend. You can add another 7.5% on top of that, which brings your total yield to 11.5%. So you're really substantially increasing the yield that you have by selling cover calls on the stocks that you own, that you simply don't believe it's going to make the straight arrow higher. If you think it's going to make a straight arrow higher, not a good time to sell cover calls. But as long as you think the stock is going to maybe trade within a range or maybe even pull back a little, that's when you want to sell that cover call, generate some income. As you can see, the yields usually are pretty compelling. And the only time that what you're doing is that, so if I sell this October 25th for 42.5, what I'm basically saying is that between now and the October 25th, which is roughly here, I don't think the stock is going to go above that strike price. So as long as it stays here within this range or moves lower, it's okay. The only time what happens is that if the stock rallies up to $44, I've now sold my stock at 42.5, and I've basically taken profit on the stock at 42.5. And that is, in essence, what a cover call is. So, like I said, this is more of an introductory webinar to give you guys an understanding of the flexibility of options, make sure everyone truly understands what a cover call is, what buying a call, what buying a put really looks like, both from a risk perspective, but also from an upside perspective. And hopefully this enlightens you to how to use our platform to actually do that type of analysis for yourself. Even if you're brand new to options trading and you're looking at a page that looks like this and you're saying, I have no idea where to start, what we want to do is we want to put a tool in your hand that allows you to start learning, start exploring. Even if you're not ready to start trading, start taking your time to take a look at calls and puts and selling cover calls, because that's the only way to learn. So with that, I want to thank everyone for taking the time out here this afternoon. At this point, what I'll do is I'll open this up for Q&A. I know there's a lot of questions already that were answered, that were asked in the chat window. So if you have any questions, please type them into the chat window and I will answer as many questions as I have time for. And I see already one question here from Maggie asking, how do I access Options Play for free? You can access it by clicking on this link, which I just posted into the chat window. Again, everyone here on this webinar gets free access to this tool. Only in Canada. This is a great offer that the Montreal Exchange is providing everyone. Bi-weekly options education webinars like the one that you're on right now, free options video library, and weekly cover call and short put reports. And I see the questions already flying by, so let me try to get to as many questions as I have time for here. So Claude is asking, what are the trade ratings numbers based on? For example, sell shares 95, buy put 69. Great question. So it's really simply based on the risk to reward ratio of each strategy. So as you can see, each strategy has some green and it has some red. Green means potential reward, red means potential risk. And what we're doing is we're seeing how well balanced these two are. So if you see something with a lot of green, then you're gonna get a higher options play score, meaning better risk to reward ratio. If you see a lot of red, that means it's worse risk to reward ratio and you'll get a lower options play score. So I hope that answered your question. Giovanni is asking, how do you apply the Greeks to a bull call spread? So Giovanni, I would love to get into that, but that's something that we do cover on our vertical spread strategy. But effectively what you're doing is you're netting out the deltas of the two legs. You basically, it's basic addition really. So if you have a long leg where you have a positive 50 delta and you have a short leg that has a negative 15 delta, then your net delta is 35 delta because you net the two together. So that's how you would utilize that. Debbie's saying, where do I find delta and theta? Great question, Debbie. So you can, on any strategy, you can click on the blue share button on any, or you can just click on the P&L graph. And there's a button here at the bottom that says explain strategy in Greek. So we'll show you the Greeks here down here. And we also try to explain it to you in plain English, so it's a little easier to understand. Maggie's asking, where do we find the replays, replay seminars? Great question. So let me get you a link. So I just posted a link to everyone in the chat window for those of you that want to access the video library, as Maggie just asked. Shantha, hi Tony. What kind of strike should one go for if you were to get a movement on a day-by-day basis? So first of all, options is not really a day trading vehicle because options are not very liquid. So transaction costs are substantially larger and it's difficult to overcome those transaction costs within intraday. But if you were to trade intraday, none of the things that I expressed would change. The strike price selection will be the same regardless of whether you're trading intraday or longer term. I wouldn't change my strike prices depending on my holding period. You might want to change your expiration dates, so you might not go a month and a half out if you're trading a shorter term. You might maybe trade a 3 or 4 week option, but I wouldn't change my strike price. Joseph, thank you so much. I really appreciate it. David is asking, I joined late. Will this be available after? Yes. So all of our webinars are recorded. Not only do you get the recording, if you are registered for this, you also get the slides as well. Val is saying, I have a question about cover calls that I sold when it was in the money. If theta reduces the cost of the option by 5 cents per day, does that mean that the cost to buy to close my cover call that I sold will diminish every day and I can make money? So Val, your answer is correct as long as the stock doesn't move against you. So if the stock moves against you, you have to factor the fact that delta will also affect the price of your option. So in this particular example, right? So if this stock was to move, was to decrease by 5 cents per day, that is correct. The value of the option, that the cost of buying back that option will decrease by $5 a day. But if the stock moves up by $1, then you would negate effectively 10 days worth of time decay by just a $1 movement in the underlying stock. So this is actually your biggest exposure. Whenever you're selling or whenever you're buying or selling any options, delta is your biggest exposure because just a $1 move in the stock offsets 10 days worth of time decay here. So you are correct, but you also have to factor delta. How can a vertical spread be less costly than buying one call? Great question, Jacques. So the question was, how can buying a call spread be less than buying a call option? So a call spread costs less because a call spread is buying the same call. So as you can see here, what I'm doing is I'm buying the $40 call just like the regular call, but at the same time, I'm selling a $44 call against it. So it costs less because it cost me $1.62 to buy the $40 call, right? That's what I'm buying here. As you can see, I'm buying the $40 call for $1.62. But what I'm doing is I'm selling a 44 call. And by selling 44 call, I'm collecting 20 cents. So that's how we go from 162 down to 142, because it cost me $1.62 to buy it, but I'm selling it for 20 cents. So I'm actually receiving 20 cents. So that's why the net cost is less by 20 cents, because by selling that $44 call, I've reduced my cost by 20 cents. So I hope that answered your question, John. Claude and Giovanni, thank you very much. Shanaz, thank you so much. RK, same thing, thank you so much. Jeff, thank you. Val, thank you. Let's see. Okay, looks like I got some questions on the Q&A side. Sorry about this. The weekly cover call and short put reports you send us, are they all Canadian stocks? Any chance you get a report at least on a few US stocks as well? So Agnes, we do have a whole US side to Options Play. So if you want to sign up for optionsplay.com, you get a free 30-day trial for the US side, and we do send you US cover call and short put reports if you sign up for the US side. You just go to optionsplay.com for that. It is not free like the Canadian side, but you do get a free 30-day trial. Bruno is saying, if I am bullish, on which occasions would I prefer to sell a put rather than buying a call contract? That is a really good question, Bruno. So let me use an actual example to, let me go back to XIU. So selling a put only allows you to take advantage of the fact that a stock is not going to move below a certain price. So when you sell a put, let's say in this particular case, I'm bullish on XYU. And the question is, when should I decide that I should sell a put option? So let's say I sell the $25 put versus buying a call option. And the difference between selling a put is that it doesn't matter whether the stock moves like this, or moves like this, or moves like this, or moves like that. I make the same amount of money as long as the stock doesn't go below that $25 level. In all of these ranges, I make the same amount of money, okay? And the only time I lose money when I sell a put is if the stock moves below that level that I sold the put at. Conversely, when you buy a put option, it's just the exact opposite. If the stock, when I buy a call option, if the stock moves below my strike price, doesn't matter whether it moves down here or down here or down here or down here, I lose the same amount of money. But as a call option, the further and higher it goes, the more money that I make. So that's a difference. When I sell a put, I'm basically, you should really only sell a put if you think that you're mildly bullish, meaning if you think it's going to go significantly higher, you want to buy a call. But if you think it's going to go maybe like this, maybe it'll be like here, but it'll move a little bit around here, that's when you want to sell a put. So I hope that answered your question, Bruno. I know that that was a difficult question to answer, but I hope I answered that for you. Agnes is saying, would you ever sell at the money or in the money calls in order to have more significant downside protection? So Agnes, personally, I would never sell a cover call that's in the money, because if you really need downside protection, you're better off just buying a put option or putting on a collar. Selling an in the money call, yes, gives you more downside protection, but also completely caps your upside gains. Now, what is the point of owning that stock if you can't participate in an upside? I would argue that there's no point in buying and holding on to that stock if you're not going to get any upside. So that's why I never sell an at the money or in the money call. If you want more downside protection, just buy a put or buy a collar. Agnes is saying, how do I access TMX? I hope I answered that question. Agnes is also saying, can I use options play on US stocks? So yes, you can use it at optionsplay.com. You can sign up for a free 30-day trial for options play. Vince is asking the same question before about, is this recorded? So both the recording and the slides will be made available to everyone after we finish here today. Let's see, Agnes, one other question. How would you compare the advantage or disadvantage of buying at the money? So I think I've covered this already. Agnes, if you want to learn, if you want to email me separately on selling in the money calls or puts, you can send me an email at info@optionsplay.com. I'm happy to discuss that with you offline. Also, your question about volatility or calculating implied volatility. I'm sorry, implied volatility. Happy to discuss that with you. Just send me an email at info@optionsplay.com. Kaz is saying, can you buy back your cover call once you've sold it? Absolutely. As long as prior to the expiration date, you can buy or sell a call or put that you've sold or bought. So you can do anything before the expiration date. Once the expiration date comes out, you cannot buy it back. Jock is saying, yes, thanks. Just one more question. Given that a sell involves a vertical spread, is the risk limited by the purchase of the call? Yes. So in a call or put vertical, right? So let's go back to that BMO, or I forget which trade I was talking about. But whenever you're buying this this vertical spread that only costs 202, that is your total risk. No matter what happens, you cannot lose more than $202 on a call vertical and the 225 on this put vertical. So yes, that's one of the benefits of trading these vertical spreads, is that you get to risk less money and you potentially get a higher return if the trade goes in your favor, because it costs you less money to get into that trade. Let's see, Val is saying, do you still sell an in the money call if you're bearish and want to buy it? So again, Val, sorry, this is, I would not sell an in the money call. If you're bearish on it, just simply sell the stock, take profit on it, buy it back later when you want to take profit, because I don't see the value of selling an in the money call. If you really are bearish, put on a collar. It doesn't cost you any money potentially to put on a collar, and you really protect yourself to the downside. Truly protect yourself, because even an in the money call gives you a little bit more downside protection, but it's still not truly protecting you to the downside. If the stock moves 10% lower, even if you sell an at the money call or in the money call, you're still not protected to that 10% move to the downside. So if you truly are bearish, put on a collar. Shantha is asking, hi Tony, selling a put versus buying a call, is this similar to long call vertical versus short put vertical? Exactly. It is exactly like choosing between the long call vertical versus selling a short put vertical. Claude is saying, your US platform is really interesting for Canadians because it offers some functionalities found on Tasty Trade platform, but Tasty is not available to Canadians. Okay, great. I'm glad to hear that. Val, thank you so much. You're welcome. Shantha is saying, will you be covering collars in future webinars? So that's a great question. We are currently looking at new topics. We've covered a lot of things over the last year or so. So collars is actually one of the topics that I think many people have asked for, outside of repair strategy. So those are the two that are in the books to cover in the future, because those are two that I have not covered in the past. Agnes is saying, would you break out trades with a hedge so you can place a larger capital on them? I'm not sure what you mean by that, Agnes. If you can clarify, I'm happy to answer that question. So I am at the end of my time, and I am at the end of my questions. So thank you so much, everyone, for taking the time out here this afternoon. I really hope that you guys have found this useful in helping you better understand these strategies, better understand how to utilize options play to help you explore and analyze option strategies. And we are dedicated to helping you continue your options education by doing these webinars every 2 weeks, making sure that we cover a variety of topics, right, regardless of whether you're a beginner or advanced trader. Raymond, Demir, thank you so much. Jock, Raymond, you've been with us for multiple years now, coming to these webinars every single week. Thank you so much for your participation. Again, thank you so much, everyone, for taking the time out here this afternoon. If you have more questions, please email us at info@optionsplay.com. And for those of you that do not already have access to Options Play, please sign up using this link here. It is free of charge to everyone, so please sign up, and this way you can interact with us and ask us more questions. Thank you so much. Have a great evening, and I'll see you guys in a couple of weeks.